Wow, hello everyone. What is a spread? Or what are spreads in Forex? What are pips in Forex? What are lots or lot sizes in Forex trading? In this video, I'll be explaining to you what spreads are, what pips are, and what lots are in Forex trading. In Forex trading, three fundamental concepts every trader must understand are spreads, pips, and lots. These terms are central to how trades are executed, how profits or losses are calculated, and how much you actually pay to enter and exit the market. This video explains these concepts clearly and in detail to help beginners grasp their importance. What is a pip? A pip is price interest point, PIP, or percentage in point, PIP, and represents the smallest incremental price move a currency pair can make based on market convention. For most currency pairs, a pip is a change at the fourth decimal place, or 0.0001. For example, if Euro USD moves from 1.1050 to 1.1051, it has moved 1 pip. For currency pairs involving the Japanese yen, a pip is usually the second decimal place, 0.01, because these pairs are quoted differently. Example, if Euro USD price moves from 1.1200 to 1.1250, it has moved 50 pips. It has moved 50 pips. Pips allow traders to measure price changes and quantify profits or losses in trading. The value of a pip depends on the lot size traded. Now, let's look at what is a spread. The spread is the difference between the bid price, that is price to sell a currency, and the ask price, that is price to buy it. It represents the cost of trading, the fee brokers charge to execute your trades. Spreads are usually measured in pips. For example, if the bid price for GBP USD is 1.3089 and the ask price is 1.3091, the spread is 0.002 or 2 pips. Spreads vary depending on currency pair liquidity. Major pairs have tighter spreads. Market volatility. Volatile markets have wider spreads. Broker types. Market makers usually have fixed spreads. ECM brokers offer variable spreads. Then time of day. Spreads widen during low liquidity times. Traders need the price to move by at least the spread in their favor to break even. That's why when you place a trade, the trade already is a minus. That is the spread. Now, what is a lot? A lot is a standardized unit of the currency amount you are trading. It determines how many units of the base currency you buy or sell. There are several common lot sizes. The number one lot size is a standard lot size, which is units of base currency is 100,000 units, and it is the most common unit size. Then we have the mini lot, 10,000 units, and it's 1/10 of a standard lot. Then we have the micro lot, 1,000 units, which is 1/10 of a mini lot. Then we have the nano lot, which is 100 units, which offered by some brokers for small traders. The lot size affects how much each pip movement is worth in monetary terms. Now, how pip value relates to lot size. Each pip has a different monetary value depending on the lot size you trade. Standard lots, each pip is worth approximately $10. Mini lot, each pip is worth approximately $1. Micro lot, each pip is worth approximately $0.1. For example, if you buy one standard lot of Euro USD at 1.2 and the price moves 10 pips, that is 1.2010, your profit is roughly $100. That is 10 pips times $10 per pip. Now, why does these concepts of pip, spread, and the lot, why do they matter? Spreads are a trading cost. Tighter spreads mean cheaper trades. Pips are essential for measuring price movements and calculating profits or losses. Lots determine trade size and risk exposure. Traders use pips and lots to manage their trading risk and position sizing effectively. On this channel, I teach you how to make money online and offline. I encourage you to join my membership by paying a token so that I can be able to also get some value from you. Normally, this video I'm making, people teach it and they get paid both online and offline, but I'm offering it here for free. So if you think that, oh, let me support this man, below this video, there's somewhere there you find where the right join. Click on it and the instruction on how you can support me is there, and then you can do that. I'm going to be mentioning your name in my videos as my supporter and as my channel member, and there are many other benefits for you. Now, I need to let you know that anywhere you're watching me from, let me know in the comment section below. Like I am making this video for my studio in Ilorin, Kwara State, Nigeria. Let me know where you're watching from, whether you're in Nigeria, Lagos, Ibadan, Port Harcourt, maybe even Ilorin or Ibadan, or any other place in Nigeria, or in Africa, or any other place in the world, whether you're in USA, in Canada, anywhere you are, or even in India, or Bangladesh, or from Nepal. Let me know. So, in conclusion, understanding spreads, pips, and lots is fundamental to forex trading. These concepts define how costs are calculated, how much is at risk in each trade, and how profits or losses are quantified. Mastery of these basics helps traders make informed decisions and manage their trade systematically. I'm going to come your way again in the next video. If you have comment and question for me, ask them in the comment section below. So, you know, your pip and your lot size, the lot size will determine whether you make money in Forex or whether you will not make money, or whether you will lose money, or whether you blow your account in a short while. So that is why I'm bringing you all this at this time. I want to support my channel by sharing the link of this video with your family and friends. Let others know about what is happening here, that there's somebody teaching you how to make money here. So I'm showing you the ABC for everyone. Even expert traders can also take a look at all these videos to refresh themselves. Until I come your way in the next one, this video popping up by the side from my channel is the next one you need to watch now. Kemcho. Madam Achu. Bye for now.